Well, equity markets are hemorrhaging money globally and emerging markets are bearing the brunt, investors fleeing from what they see as risky assets. But surely at some point valuations become so attractive that money starts flowing back. At least that's what history teaches us and what the textbooks will tell you. This is the Moneymakers. I'm Bruce Whitfield. Tonight, chatting to Mohammed Nalla. He's the head of strategic research at Nedbank and Hlelo Giyose, chief investment officer. He's also deputy executive chairman, wearing matching tie and handkerchief of First Avenue Investment Management, about where to find certainty in the global mess that we're in. I suppose the obvious answer to that, Hlelo Giyose, is there is absolutely no such thing as certainty. If there was such a thing as certainty, you'd be out of a job.
Well, there are various degrees of certainty, and
50 shades.
50 shades. Well, we break it down to 4 shades. The low uncertainty, which is really what investors want all the time.
When was the last time that we were in this period of low uncertainty?
Well, the past 7 years.
But it's been massively uncertain.
It's looked uncertain. but when was the last time the United States moved on interest rates? When was the last time there was so much money to buy anything you wanted to buy? When was the last time that companies had so much support to either put money into CapEx or put it into government bonds, or to buy back shares, or to pay dividends? When was the last time you had that much certainty capital allocation?
Okay, so if the last 7 years have been that almost absolute certainty, the other 3 shades?
Well, then there's medium certainty, which is on your way to high certainty, and extreme. So extreme is 2008, the financial crisis. We are borderline medium to high. We're probably towards a high part of the uncertainty scale. Now, the point of the matter is that every now and again you have macroeconomic factors. When I say every now and again, every 5 to 7 years, you have macroeconomic factors which spike up. You might have interest rates go up, even though these days they're going up increasingly less than they used to. Might have inflation, you might have money supply contracting, might have all those things. The idea, though, for an investor is never to fight as if at some point you're going to have to block and at some point you don't have to block. You have to have the guards up at all time. And there are companies that just persevere and persist with prosperity across downturns and upturns, and those are the ones that give you certainty even in moments of uncertainty.
Okay, I'm going to talk about those. He sounds a bit like Donald Rumsfeld did in the days of the invasion of Iraq, where there are some things we know, there are some things we don't know, we don't know. That whole thing, okay? Feels a bit like that, but we'll come back to the companies that give us the certainty. Do you agree, though, Mohammed, that we are sitting at that, we're not quite at the extreme of 2008 madness, but we're about 3/4 of the way down the scale that Hlelo has drawn us in terms of uncertainty?
Yeah, I think we're certainly going into a period of high uncertainty, and the fact of the matter is that it depends on where you've been sitting. If you were sitting in US markets over the course of the last couple of years, I absolutely would buy that argument. I think if you've been sitting in emerging markets, you've had a torrid time of it in hard currency terms, probably for the last 4 years anyways. So in the context of a Fed hiking rate, in the context of commodity prices that continue to fall, and the possibility that deflation is not just something that nut jobs cook up in a corner, that it might actually be a reality that the world might be facing, certainly on the good side of things. With all of these things, the fact of the matter is, going to Hlelo's point around uncertainties, the world does not know how to deal with a deflationary environment.
When last were we in a deflationary environment?
Well, effectively, the biggest example of deflation would be Japan, and Japan hasn't really escaped that deflation. They're still grappling with that up until today.
But Japan is far from broken. Japan has got high employment rates, it's got very good lifestyles for its people.
Premised on a massive debt build. And the problem here is that the world is starting to realize that if you premise your growth on a massive build-up in debt, all you end up with is a misallocation of capital. Again, to Hlelo's point, is that you're going to find companies there that have actually allocated their capital correctly, that they will generate pleasant returns for their investors. But unfortunately, it comes in this big macro context. And unfortunately, when global sentiment turns, they tend to throw the baby out with the bathwater. So even those good quality companies will get punished, and prudent long-term investors should use those as opportunities, I guess, to go long the stocks. But right now, I think we're just at the start, quite frankly, of the uncertainty. We've only started to see US markets roll over in the latter part of last year. And I saw an interesting graphic that it's mapped US equity markets against presidential terms. And they say in the last bit of 2-term presidents in the United States, in that last year, markets collapsed. They continue collapsing into the early part of the newcomer's term and only start rebounding thereafter.
It all depends on who the newcomer ends up being, I suppose, in the United States. If it's Hillary Clinton, all bets are off. Yes, anyway, less said about American politics, the better. All right, so Give me a sense then of South African companies, maybe some global companies that provide you with that level of certainty that even if they pull back along with the market sell-off of 20 or 30%, they will be the first ones to recover back to decent levels when things become better.
You know, we're extremely blessed in South Africa that we have about between 50 and 70 companies that are what we like to call quality rich. They don't necessarily have to be have offshore exposure. You know, the normal culprits, the SAB or AB InBev now is what they call it, British American Tobacco, the Richmond, they don't have to be that. Look at a simple company like Clicks, which completely dominates the profit pool in this industry, 33% of market share. When you have uncertainty to consumer income, what's the consumer going to do now? They're not going to stop buying deodorant, they'll just downtrade. Clicks' private label business is geared exactly for that. You can get good quality deodorant for much cheaper than a branded one. Those kind of businesses, they price forward inflation, they give it to the consumer. If you have deflation, they can price for the effort they take to bring the goods to you. Many businesses cannot do that. Look at Woolworths. When you have a combination of price increases with volume growth, and those two never go together. No. But when you have both of them, it's a wonderful opportunity for the company to share parts of those proceeds with the investor by way of growth in dividends. And growth in dividends can be greater than growth in earnings because cash flow is not the same thing as earnings anyway. Sure. So we have a number of these examples. Metrofile, which is simply going to pass on a cost-plus type pricing, which is driven by the regulatory tailwind of having to store documents. You just have to find these companies, but there are many of them.
Okay, so in the retail sector, you've given us Clicks and you've given us Woolworths in there and Metrofile, which keeps coming up as a clever, well-run company. Distel, sure. Good product.
Sure.
Mohammed wouldn't understand. But I mean, they're good businesses, Mohammed. They're hard to shoot down.
Yeah, look, I think, the investment case is certainly there. Hlelo is more the expert in terms of stock-specific calls right here. But if I just have a look at it on a slightly more macro level, I'll tell you what I'm struggling with is right now we've got this dichotomy between emerging markets, developed markets. And if I have a look at some of the valuations of these stocks, notwithstanding the fact that they are still reasonably defensive, if I compare those to some of the stocks in the developed world, some of the stocks that have similar characteristics, it's looking as though that they're fairly richly priced. And so on that basis, I'm struggling to understand, if you're a South African investor, but you've got the possibility to go offshore, what's the investment case there for coming to a stock like that carves up its space in a very niche market, but a market where I must add the purchasing power of that consumer will be eroded, regardless of how defensive the company is.
Let me put it this way then. All right, so I've got 100,000 Rand, hypothetically. I could switch that into pounds, go through a Reserve Bank process, and go and buy boots in the United Kingdom. Or I could keep my 100,000 Rand and buy 100,000 Rands worth of Clicks. What do I do?
I tell you, you're making a choice where choice does not exist. You could have given me the same example and said, if I had 100,000 Rands, I could buy AB InBev, I could buy SAB. Well, AB InBev just bought SAB. What are you doing trying to choose between two high-quality companies? South Africa is the third best performing stock markets from 1900 to today, whether you splice it over 50, 70, 20, 15 years, in dollar terms, the third best performing stock market. The reason why is because capital allocation in South Africa has been exemplary relative to.
My question's simpler than the very high level hypothesis that you're playing out here. My question is, do I take a currency bet?
You'll do just as well.
Will one, even at 24, because that's what it'll cost you to buy a pound, at 24 to the pound, I'll get far fewer Boots shares than I will get Clicks shares.
But you'll do just as well with the 100,000. You'll do just as well with Clicks over, I think Boots has been purchased now by, Alliance Boots has been purchased by a U.S. company, I think it's Walgreens. Okay. You'll do just as well. In fact, very possibly Walgreens will come and buy Clicks. Very possibly. You'll do just as well.
Okay, at some point to the view, that's the optimistic view, but that's a good view on South Africa. But the macro view the economist view. Okay, one last point and then I've got to get the economist view. Okay. No, make a point.
We actually did a study recently. We went back to 1960. That's about as far as a good data we could get goes to today. And we broke it up into 20-year clips. We took the 10 most cataclysmic events, whether they're political, socioeconomic.
So Sharpeville would have been in there, Rubicon would have been in there, all of that.
I mean, here's the deal. One of them, the June 1976 riots, were terrible. That year, the government, in one day, devalued the rand relative to the pound by 18% in a day. Not in a 2-week span, not in a 2-month span. We've seen our currency fall 20% over a number of months in a day. 1976. In 1980, the market was 30% higher. Who would have thought to still take a position in the market in 1976 after that? Who would have thought it? Take 2008 crisis. Who would have thought that you could still take a position in the equity markets today, even in the United States? Take today. So all these things, currency, gold rallying, don't worry about them. They're not your business. Your business is buy good quality businesses.
Okay, good point and point well made. But you worry about economies all the time, Mohammed Nalla.
I have to, because at the end of the day, Bruce, it's for me, it's a relative game. I understand Hlelo's point in terms of it being an absolute game. If you're a South African investor, you measure your wealth in rand terms, 100%. Allocate your capital to good quality companies over a long period of time. The market that we look at is a lot more dynamic. You've got investors that have choice. They're international investors, and they can allocate that capital to emerging markets, developed markets, and they can slice and dice it as they require. So on that basis, I've got to look at the stuff that maybe contributes to the noise, but that is the main difference between a strategic long-term allocation and a tactical allocation that you're going to be getting. And quite frankly, right now, if you have a look at it, emerging markets on the back foot since 2010 to now, they remain on the back foot relative to developed markets. And most of your return, albeit from the 1900s, we might be the best performing market in dollar terms. If you have a look at our performance in dollar terms over the last year, 2 years, 3 years, it's absolutely abysmal. So in that context, keep your powder dry. Potentially, if you don't have to allocate to South Africa, the other emerging markets, if you have an emerging market flavor that you'd like to add in there, I've always banged on this point. Is I'm saying emerging markets that have currently a pro-structural reform agenda are going to outperform.
Best performer in Davos, in my opinion, other than Iran, which came with a great story to tell, was India.
Well, India is a good case in point, but another one that's lurking on the horizon that a lot of people are going to start talking about is going to be Argentina.
Yeah.
So they've replaced their president. They've come onto the table with a pro-reform agenda, and those things are going to mean that on the macro scale, tactically, you're going to see an improvement in those emerging markets relative to an emerging market like South Africa.
At that point, we have to leave it, unfortunately, gentlemen. Nice to see you both. Thank you very much. Hlelo Giyose, who's Chief Investment Officer at First Avenue Investment Management, and Nedbank's Head of Strategic Research, Mohammed Nalla, giving us perspectives on why not to panic. Thank you for watching. More market movements, more market shakers, and more market movers next time on The Moneymakers. Till then, bye-bye.